Looking at the chart right there. Let's expand our conversation. Bring in Mira Pandit, global market strategist at JPMorgan Asset Management. Welcome. It's nice to see you here today. So what's your reaction to what you got out of the Fed, and what's your investment idea given what you saw and heard?
Well, it was a surprise to see that terminal rate moved up to 5.1% as a potential for next year. But yeah, the bigger surprise to me was the distribution of the dots when we take a look at the dot plot. Because if you look back in September, 0 members of the FOMC thought the federal funds rate terminal rate would go above 5%.
Now you got 17 of 19.
Now you have 17 of 19. Not only that, but if you look at that dot plot more carefully, 7 people also said above 5.25. So it's clear that this debate over the terminal rate is going to continue into next year, which means that we're going to continue to see volatility in both stocks and in yields. Right now, I do think in the short term, yields need to reprice a little bit more, 3.5% or less on the 10-year, 4.2% on the 2-year. It doesn't really reflect an environment in which the Fed funds rate is near 5%. But at the same time, if we do end up in a recession at some point next year, which I do believe we will, very likely, then that is an environment in which yields can then come down more substantially. So I do think that legging into a bit of duration, higher quality bonds is one that will help protect portfolios in the new year.
You're referencing this disconnect, we want to use that word, between the Fed and the market. You heard Gundlach and many others suggesting, including Gary Cohn, who was on prior to us, saying that the market is right. The market's going to be right, and the Fed's going to come back to the market. If that is, in fact, the case, what does that mean for equities?
I think the Fed's biggest fear at this point is not moving from 7% inflation to 4% inflation, but it's what happens when we get to 4 and how quickly can we get below that, closer to their target. So I think the Fed has to talk tough in the interim to make sure that inflation expectations continue to stay well anchored and potentially move lower. And they need to convince the market that they are going to be tough on inflation and prevent any sort of drift back higher, that they're going to continue to be very persistent and resolute. So I'm not surprised to necessarily see them want to gear towards hawkish. Fool me once. We saw them be quite hawkish in Jackson Hole in their November meeting. We didn't really see that at the Brookings meeting, and I think that therefore we were primed to see a pushback on financial conditions this time around. But I do think that when we think about the markets next year, look, if the Fed doesn't come in as strong as they say they are today, maybe that could provide a little bit of a relief rally, but we're still going to be very restrictive on rates, and that's still going to be a headwind for the equity market next year.
One of the things that we really benefited from is that everyone was able to refinance and refinance over the last couple of years, and we really just don't have this economic slowdown being accompanied by blown up balance sheets, massive bankruptcy. In fact, most of the high yield issuers are energy companies, and arguably they look better than they have in any previous recession. But you do have a wall of maturities, probably the end of 23 going into 24, where all of a sudden that could become a fear if we're actually in recession. How do you guys express that idea to clients about, yeah, everything looks calm now in corporate credit, but it's not going to go on like this forever? Like, how does that work?
If you're allocating to credit right now, you certainly want to be in the higher quality areas in that investment grade space, not in the high yield space. We've actually seen that high yield spreads have tightened for the last 8 to 10 weeks, and we would expect them to widen quite considerably in a recessionary environment. Even if we look at spreads, during non-recessionary times, we're about 58% of that peak in the high yield market. So we really need to see spreads widen quite a bit from here in order to get comfortable with pricing, to feel comfortable with that risk-reward trade-off. So right now we would certainly gear more towards the investment grade over the high yield, again, really leaning into that quality. I do take your point, though, that some of the fundamentals in the high yield market look better. It will become attractive, but right now we don't want to get too greedy with yields.